This week we've got a couple quick news updates, and then I want to talk about oil futures, how they work, and what happened with that price last week. All of that is coming up. All right, guys, welcome to the channel. If you're new here, we talk about saving, making, and mastering your money. If you're into personal finance or personal development, please consider subscribing. So a couple quick COVID news updates for you from my area. First one is not a great piece of news, but in my province, we have had an outbreak at a couple meat packing plants this week, which has bumped up our numbers and spiked our number of COVID cases yet again. So while there are flattening curves in other provinces, and other provinces are starting to talk about when they're going to be going back, looks like perhaps in June. It looks like it won't be the case for ours, as these new numbers are definitely cause for concern. I'll leave a link to that article in the description. The other piece of news is actually good news. The feds have announced they will be giving $9 billion of aid to students. So students who are in school or graduated in December, I believe, will be eligible for some aid. I will also leave a link to that article in the description. Now, the reason I'm kind of blazing through that is because we have a big video today to talk about oil prices and the volatility in oil last week. So I actually got a comment from Mehdi asking me if I covered commodities, and I don't personally trade oil or any other commodity myself. However, I do work in an oil and gas city. I know a little bit about this. I still had to do a lot of research. So here is the product of a lot of reading and watching of videos, and I'm hoping that this will help you guys. And yeah, this one's for you, Mehdi. So the reason for the excitement is that the price of oil on the West Texas Intermediate went to the negatives last week. It was actually almost minus $40 a barrel for the barrel of oil. Now, I can confirm right now that does not mean that you get paid to fill your car with gas. However, that number is significant, and to understand how you get it, you really have to understand the supply and demand equation for oil. So oil, like any other commodity, has its price affected by supply and demand. Now, the equation is pretty simple. On the supply side, you can either make the oil, so you have production, or you can import the oil. And on the demand side, you can either export it away or you can use it. Now, because the supply and demand don't always match up, we have this buffer in the middle that's actually being able to store the oil. And storage is a key factor in how we got negative numbers last week. So if there are certain months where we didn't quite get enough oil in and we need to use a little bit more, we can take some out of storage. And if the reverse is true, which is the situation now, if we have brought more in than we have been able to use this week, we can put some in storage. Let's get that out of the way. So let's look at the supply side of the equation. First, let's talk about production. Even when the price of oil starts to slide, there are operators who will think about the economics of shutting down or restarting a well. And so even if that particular well isn't quite profitable that month, they may consider keeping it open. What happened this last month? Production didn't really slow down, although now it is starting to. The effects of the slowing down will not be seen right away. It takes some time. It isn't a light switch. So there wasn't a lot of production slowdown this last month. Now on the import side, same thing. About 5.5 billion barrels are on their way from Saudi Arabia to North America, and we will have to find places to put it, but the imports themselves have not been canceled or changed, so that is still coming. Now on the demand side, we'll talk about refineries, which is where a lot of the oil goes. With nobody leaving their house now or traveling anywhere, demand for gasoline, jet fuel, and all the other products that oil usually is used for has cratered, which means that there's an oversupply of gasoline, which has also caused the gas price to crater. Now, the reason you haven't seen negative prices at the pump is because there's still a cost to refine the gas and a bunch of taxes that are put on by your state or province or government. I know for Alberta example, 24 cents of every liter is taxes. Now, your other option would be exporting. And as you can tell, this situation exists around the world, so there is no demand. Nobody wants to buy oil anyway, so that option is totally off the table. So we go to the last thing we can do, which is basically to store it. And for the last 6 weeks, that's essentially what's been happening. Since the lockdown has started, we have been filling all the storage facilities that are in Cushing, Oklahoma and the Gulf Coast, and we've slowly started to get close to, but not quite, their limit. So you can guess that when everything is good, the economy is growing and everybody's working, oil is normally in demand and things are flowing, everything is great. However, when things are not good and there's a pandemic or some kind of disruption, or when politics get involved, that causes uncertainty and a negative effect on the price of oil. So park that over here for a sec. Now, the second part of understanding this is to kind of know a little bit about how oil is traded. Now, what makes the West Texas Intermediate unique in that it's traded in actual physical barrels of oil. This is different than the Brent crude oil price, and I'll explain that in a bit. West Texas Intermediate is the price of oil in the US, North America. It's shipped by pipeline, truck, or rail. Brent, however, is from the Northern Sea, and it's more the world benchmark for the price of oil. However, it's settled in cash, so you'll never have this negative number on Brent because no one would ever pay you to take more money. So that's what makes this different. So WTI is kind of a North American thing. It tends to be a little bit of a lower price than Brent, and it's traded in the US in Cushing, Oklahoma. Futures are a term that you're gonna hear a lot about. So futures are actually contracts. It's when you pay for something for the price it is today, but you want to receive it later in the future. Now think of something more normal like gold. What a futures contract is, a futures gold contract is basically saying, I want that physical ounce of gold, let's say, but I don't want to take it right now. I want to take it 6 months from now. So what you'd normally do is you'd say, okay, person who has my gold, I will pay for the gold and I'll pay you a fee to store the gold for me for 6 months. Now, the inverse is true for oil. Oil is usually in such high demand that people will actually pay more to receive it right away than to have someone to store it. So future oil contracts, the long-term ones, are usually lower than the short-term contracts. Now, oil contracts expire once a month, and this week it was last Tuesday. Last Tuesday was the due date for everyone to settle their contracts for the month of May coming up. Now, when a contract finishes, a trader has one of three choices to make. They can either let the contract expire and take physical delivery of that oil, they can sell the contract to someone else, or they can close the contract and roll it over by buying next month's contract. Now, here's the kind of weird part, is that a lot of people who trade oil don't actually have the physical ability to take it and store it should they need to. So there goes the first option. And because nobody really wants oil right now and there's no demand for it, the contracts kind of came to their closing date and there were no buyers to be found. So there goes option 2 for selling your oil. And that left you with option 3, and people who were holding on to those long-term contracts found it very painful to get rid of them because there was just nowhere to put them. So with $108 million worth of contracts that were still open, everybody started to clamor to try and find someone who could store their oil for them. And because oil storage was already kind of starting to fill up, the price to store the oil also went up, which essentially meant that people were paying more to store the oil than the barrel of oil was actually worth. Hence the negative number. Now, if you're wondering about those ships of oil that are coming across the sea right now, well, there is a little bit of room that is always left in storage facilities, usually for operations or for those who operate the storage to be able to pack in a little bit of cheap oil to sell at a later date when the price goes up. So in theory, there should still be enough room to store everything that is being imported this last month. Hopefully. So the next question you might be asking, well, what happens when storage fills up? Well, that's when you have a really bad news story because there's nothing else you can do than shut in wells, which means you go to your oil companies and they stop producing altogether. That's what really ruins their revenue streams, and that's when companies get in trouble. So that is what happened in May for the May contracts. Now keep in mind the June contracts are still about $20 a barrel. However, the June contracts are usually a lot higher than that. And if we run into the same issue or if things continue, there is a risk that that $20 will also drop or fall below or become negative temporarily. Now, before we move on to the last part of this video, if you guys are enjoying this so far, please remember to hit that like button. A lot of research and effort went into this video, so if you're finding value, that would be greatly appreciated. It really helps the algorithm and gets this video out to more people. Thanks. So the last part of this video is just talking about how low oil prices affect oil producing companies. When I say that, I'm talking about companies like Shell and BP, but this also really is dangerous for the smaller oil producing companies as well. To understand this, we need to understand a little bit of how oil is actually produced. So oil comes from wells that are below the Earth's surface. The oil producing companies just find ways to essentially access the oil and pump the oil up to the surface and put it in a pipeline or a train car or something to move it somewhere. Now, there's an operational cost to produce a barrel of oil and get it out of the ground. The cost has to do with a lot of different factors. It could be the location of the well, how far away it is, how deep the deposit is, and what sort of technology you need to get that oil out of the ground. And operators and these companies know how much that dollar value is. And the short version of this is when the price of oil falls below what it costs to produce it, essentially when it costs more to get that barrel of oil out of the ground than you would selling the barrel of oil, that's when companies start to look at whether they should even operate certain wells. Saudi Arabia, North America, and the OPEC plus countries right now, they are trying to find ways to reduce the production. And like I said before, it's not easy or a quick process by any means, but right now the price of oil itself might be enough of a deterrent. In fact, I'll leave another link in my description of an article talking about how certain wells are now already starting to close. One example would be something that I'm familiar with, which is oil sands. And to get the oil out of oil sands up here in Canada, due to its location and all the extra processes it takes to do so, you need oil to be about $45 a barrel to make it profitable. Any less than that, again, you start to look at turning down your operations. So if oil prices remain low, producers will just start to turn off the taps, and that's bad for their pocketbook, which means it's bad for their stock. And that's essentially how this whole thing is bad for oil companies. Now, before we wrap up the video, I wanted to do one more thing because I'm sure we're kind of wondering whether this whole thing between Russia and Saudi Arabia and the politics at play between their oil production has caused oversupply in the market. It sounds like Russia and Saudi Arabia have reached an agreement in order to reduce the amount of oil they're producing. But this is where I was kind of saying that politics play a role in the prices. Saudi Arabia can produce oil and be profitable at $10 a barrel. And they sometimes use that in order to manipulate the price and put pressure on other oil companies. Low oil prices are bad for those small producers that won't be able to survive the season. And that's when they start to get gobbled up by all the big companies like the Shells and the BPs. Well guys, that is all I've been able to research and put together for you this week. If you found it educational or valuable, please again remember to hit that subscribe button for more content like this. So Mehdi, I hope you liked this video, and for everyone else, until next time, have a great week, spread the wealth, and I'll see you in the next one. Bye. Now on the demand side, first I'll talk about exports. Now on the demand side, I'll talk a little bit about exports. Not a lot of countries right now need this oil. On the demand side, I'll talk about the number one reason, which is on the demand side, and what happens to be the number one reason